So another very common question I've seen being asked around on the internet about options trading is, should you hold any kind of short option position through expiration? So that involves things like debit spreads or credit spreads, iron condors, cash secured puts, covered calls, any kind of strategy that involves selling an option. Should you hold those kinds of trades through expiration, or should you close them out early? Now, as you'll see in this video, there's actually a very specific reason why, in my opinion, you should almost never hold these kinds of trades through expiration. So obviously, as I kind of implied there are a few exceptions to the rule, but generally speaking, you should always close these kinds of trades before the expiration date. Now, as always, before we dive in here and I show you that exact reason, in case you are brand new to the channel, my name is Scott Reese, and I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in case you want to see more trading or investing content after watching this video, you can also find me on SKILLSHARE as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. Alright, so first off here, we must take a very detailed look at the definition of the expiration date for an option contract. So in particular, the expiration date is the last time for the owner or the buyer of that option contract to exercise it. And specifically, the exercise notice to their broker must be received on that particular date for it to be effective. Now, at a first glance, that definition probably seems pretty straightforward. And you might be thinking, what's the big deal, Scott? Well, the big deal is if you take a deeper look at that exercise notice portion. In particular, the option contract can be exercised at any point on the expiration date. So therefore, that means option assignment does not necessarily occur right when the market closes at 4 p.m. Eastern time on the expiration date, right? Because you also have to consider the after hours trading session as well, which starts at 4 p.m. once the regular session ends and continues all the way until 8 p.m. Eastern time. And during this window, it's only stock and futures trading. No options are traded after hours. Moreover, once the regular session ends at 4 p.m., the vast majority of market participants sign off for the day. So that means the after hours session has very little participants, and the liquidity of the stocks trading during that time is very poor. So ultimately, that means you're going to see very wide bid-ask spreads and very choppy or gappy price action for those stocks during that after hours session. And so now, keeping in mind that, as I pointed out, options can still be exercised at any point on the expiration date, this means if you sold an option that you thought expired out of the money, but if after hours the stock moved to make that option become in the money, you are now at risk of assignment. And because no options trade after hours, there is nothing you can do about it. And depending on the kind of position you have on and your account size, you could potentially find yourself in a lot of trouble. And so now at this point, let's walk through a very detailed example so you can see how things could potentially play out in a few different kinds of scenarios. So let's say for our example here, you sold a simple put credit spread. And in particular, for your short option, you chose the 100 strike. And for your long put option, you chose the 95 strike. So this is a $5 wide put credit spread. And you sold this one for, let's say, $200 in premium. And also at the time you placed the trade, the stock was trading at $105 per share. So initially, this is a great setup, right? As long as the stock stays above your short put strike of 100, then by the expiration date, you'll keep the full $200 in premium. But now let's say we fast forward to the expiration date, and on that day, the stock closes at 4 p.m. after the regular session ends at $101 per share, just a single dollar above your short put strike. And so at this point, you might think that you are now free and clear on the trade, that you're going to keep and walk away with the full $200 in premium. But now let's say after hours, which again starts at 4 p.m. and goes all the way till 8 p.m. Eastern time, let's say during that window, some bad news broke out about the company. For example, perhaps a possible scandal broke out about the CEO of that company. And therefore, as a result of that news, the stock immediately drops after hours to a price of $96 per share. And let's say it stays roughly around that price all the way until the after hours session closes. So now at this point, your short put option with the 100 strike is now in the money, and you're going to get assigned on that put option, right? Again, as long as the option is exercised at some point on the expiration date, it is still valid. But this also means your 95 strike long put option is still going to expire worthless. So basically, you're just going to get assigned on the short put option with the 100 strike, and you're going to have to buy 100 shares at that price, at $100 per share. And come Monday, that's going to be the new position that you're going to have on. So let's say when the market does open on Monday morning, the stock is still roughly around $96 per share, and you decide to simply sell those shares to completely close out of your entire position. So ultimately here, the final P&L or the final outcome of your trade would be calculated as follows. Your purchase price of the stock from the assignment was $100, and the sale price of the stock on Monday morning was $96. So that's going to be a loss of $4 per share times the 100 shares. That's a total loss of $400. But then, of course, you still do get to keep the $200 in premium that you sold the put credit spread for at the beginning. So we add that on, and that means the final outcome of this trade is still a loss of $200. Now, the outcome of this scenario is definitely not too bad, right? Because again, with a $5 wide spread and collecting $200 in premium, that means the max loss on that put credit spread was actually $300. So obviously that's more than what you actually did lose in this scenario, but you still lost money in this situation when originally on the expiration date, you thought you were going to make a full $200 profit. But now let's take it one step further and take a look at a worst case scenario, which has actually happened many times in the past. So in this case, we'll still have the exact same setup, same put credit spread, same strikes, stock drops to $96 per share after hours on expiration date, etc., etc. But now over the course of the weekend, let's say some even more bad news breaks out about the company. For example, perhaps the rumored scandal about the CEO is actually true. And so now come Monday, once the market reopens, the stock immediately drops even further down to $75 per share. And so at this point, you decide to simply sell the shares once again and exit the entire position. So now the final outcome of this trade would be calculated as follows. Again, same purchase price of the stock at $100 per share from the option assignment. But obviously the sale price of the stock on Monday has dropped to now only $75. So that means you're going to face a loss of $25 per share times the 100 shares. That's a full loss of $2,500 on the stock. And then again, you still keep the full $200 in premium that you sold the put credit spread for at the beginning. So the final P&L of this trade here is a loss of $2,300, which obviously is well beyond the max loss of the put credit spread of only $300. And moreover here, I'm sure you can imagine if this kind of scenario played out on a much higher price stock, something like Amazon, for example. So if you were trading put credit spreads on Amazon and this kind of thing happened to you, you could face losses of tens of thousands of dollars. So in conclusion here, as a general rule of thumb, always close out a position that you have on that involves a short option contract before the market closes on expiration day. Right? Because again, once the market closes and the after hour session begins, only stock can trade, not options. And the only two exceptions to this rule would be if number one, you are totally prepared and equipped to handle a possible assignment, right? For example, if you are selling covered calls or cash secured puts, then assignment might be a part of the plan. But if you are selling credit spreads or iron condors, then chances are assignment is definitely not a part of the plan. And then the second exception would be if come expiration day and the options you have sold are super far out of the money, right? For example, if the stock would have to move like 50% after hours just to even reach your short strike, then at that point, may as well just leave the trade on, let the options expire worthless, and not spend any money to buy them back. But if those two exceptions do not apply to you and your positions, then just do yourself a favor and spend the extra few bucks to buy the contracts back and close out your trades before expiration. Because if you do that, then there's absolutely nothing that you have to worry about. And so with that being said, that's going to do it for this video. I hope you enjoyed it. And please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my SKILLSHARE courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.